Today, folks, we're diving down into one of my favorite real estate investment trusts of all time. And of course, I'm talking about that Riocan, which if you were buying it a year ago, you have made an incredible return on a really foundational company as it's currently trading up 48%. The starting yield is 4.2% with a $7 billion market cap. And we're going to go over everything about their most recent earnings to see if this company is still worth buying today. But if you're OG to this channel, you might recall that going into this earnings, I actually sold 30% of my stake in Riocan, and that wasn't anything to do with me being bearish, more primarily to my risk tolerance and diversifying my income and my portfolio, because currently I still hold 1,070 shares. I'm up 32%, and that cash flow currently is making up $1,027 of my annual dividend income for that juicy passive income. This is incredible, and even still after scaling Riocan down, making up 8% of my total portfolio, the dividend income, however, still makes up 12% of my annual income. But I took that money and I diversified it into MPW and Stag just to give me a little protection. And again, not that I'm bearish. So let's get into these recent earnings and these filings just to see if it's still fair valued here, in my opinion, or if it's still even worth buying. But let's start with the stuff that really matters. In the middle of this pandemic, are they managing to bring up their rent collection? Because obviously this was one of the biggest hits they took, being primarily encored by malls still, which we'll get into. But taking a look, guys, this is phenomenal. Q2 of 2021, they collected 94.9% of their rents, and that is on track with the prior quarters. However, what they don't mention in here, or that isn't actually as apparent, is that the remaining rent to be collected is 3.2%. And this is primarily because a lot of tenants will pay in the following month that isn't getting attributed in for this quarter, and that would bring them up to about a 97-98% rent collection, which is phenomenal. And the best part about seeing that we might be on the other side of the pandemic here in Canada is the fact that when you look at the provisions and the deferred rents, because the provisions are money they're losing. These are tenants that are bailing, and the deferred rent is renters that say, hey, we need a break because we need to wait till we can open back up again. And these have dropped massively. Deferred rent has gone from 2.4% in Q1 of 2021 to now where it's at 1.8%, and the deferred or the provisions are down to 0.1%. And they were at 0.7 last quarter. So we are on track to see some pretty good stuff if we don't see a flare up like they're experiencing in the US. And luckily the vaccination rates are here are pretty good, but I'm not going to speculate on that in this video. So taking a look at the committed and in-place occupancy, currently committed, they have 96.1%. So this has been nominally on track for the prior quarters, which is really good. That just means, hey, 96% of our tenants are committed to pay their rents. Absolutely wonderful. Now taking a look at the, tenant diversification, and the reason I love this company is because they're largely encored by grocer, pharmacy, and liquor, value retailers, and essential personal services. But where they've seen the biggest hit so far in the part of the portfolio that scares me is obviously with apparel, movie theaters, which Cineplex has just started opening up again. But 4% of their entire portfolio is encored by Cineplex. A little scary right now, but taking a look, I think it's funny because they say that apparel's over last year is now down 40 basis points, about 40% over the year prior, but I don't think that's by choice. So I don't know why it's in a green arrow, considering I think most of these apparel stores just went belly up. But this is good overall because we're seeing a 60% or 60 basis point increase in the grocer encored centers. So this just means they are really trying to foundationally get tenants into these new buildings that are going to be primarily based on those grocer, pharmacy, liquor-based businesses, which are much more stable and is what's generally been keeping this company alive. But let's get into some of the actual earnings. So they posted a funds from operation of about 40 cents, which is a fairly large increase even over Q1 of 2021. And I think part of this is due to the fact that they have been selling interest in some of their condo buildings, which we're going to get into in a sec, more related to the development side of this investment. But at 40 cents, guys, let me just show you how great this is, because if you're looking for stable cash flow, currently their dividend is only 0.08 cents since the cut, and that cut hurt me a lot. There was a 30% cut considering in 2020 they were paying $1.44, and now I think they're closer to like 90 or 80 cents or something like that. But at 0.08 cents a month, you're looking at about 24 cents of dividend income per share a quarter. So think about that. Their funds from operation was 40 cents. Their dividend payout is only 24 cents. So they're leaving a lot of bleed room right now to continue paying this yield, which is exactly what I want to see. But let's talk about some of the development coming down the pipeline, because unlike my other REITs, with Stag, with MPW, they've done a fabulous job building out their real estate portfolio. They do it by diluting shareholders to raise capital. They don't want to take on debt, so they dilute us as shareholders and they reinvest the capital. What I like most about Riocan right now is they haven't done that. They just invested their own capital, not diluting shareholders, and they have a lot coming down the pipeline. I mean, check this out, guys. They have 13.7 million square feet that has zoning approved. So these are things that they can start constructing or finishing construction or whatever they have to do. They got 6.9 million in zoning applications submitted. So these will hopefully be new projects. There's 6 projects with submission, 39 projects that already have zoning approved, and 15 projects being 19.9 million square feet of pending applications. Like, oh my God, guys, 40.6 million square feet of new development coming online. This is what makes Riocan so beautiful, especially if you were buying it at those discounted rates, a year ago. But let's just take a look at some of these actual properties, because this is what we can see kind of coming online with Frontier and Ottawa expected completion of Q1 of 2022, launching in March of 2020. So this is one that should start showing up some cash flow in Calgary. We got another one over here that has a targeted occupancy date of Q3 of 2021, Lithio, Toronto. But let's take a look at some of their premier centers. Looking at Strata, a premier property in Toronto, its current occupancy targeted date is Q4 of 2021. Latitude, a massive property here, guys. This 23-story, 288-unit residential building is looking to be on target for Q1 of 2022 for occupancy. And just taking a look, guys, look at the townhomes that they have. Most of these are sold out. Except, well, I mean, all of them are pretty much sold out. The big ones to me are the Yorkville property, the 11 Yorkville condominiums, because this is a massive 586 unit property. And it's already 99% pre-sold with the completion date and the occupancy date coming in at 2025 time frame. And then same with these big Queen and Ashbridge, which aren't coming online until 2025, but still 92% sold. Unbelievable stuff. Taking a look at these dead ones and zeros real quick, guys, we can see that their debt to asset ratio has been really phenomenal. They've actually decreased it over the last quarter, and I'd be curious if this is what they're doing with the extra cash flow from the dividend cut. But currently their debt to total assets is only 44.7%. And this is absolutely beautiful. And if I go on to Yahoo Finance, guys, I like the fact that I can see the numbers clear as day here, because currently, as of 2020, and a lot has changed in this year already, but their total assets were 15.2 billion against their current total liability of about, we got to scroll down, their total liability of 7.5 billion means they have about 7.5 billion in underlying asset value if they liquidated all these properties today, which puts them at really fair value for their market cap. So you're basically buying it for the underlying asset value as it stands today, which is a rarity, to be honest, in a lot of real estate investment trusts. And then if we scroll down just to look at the little chart that they offer here, we can see that they are starting to come back from those lows of Q1 of 2021. Their earnings are coming back. So it'll be nice to see if this can continue into the latter half of the year. On top of that, with these new tenants coming online, I would not be surprised if sometime in 2022 they start talking about re-increasing the dividend, or if I wouldn't be surprised, maybe even some share buybacks. But I got to get on the conference call because I've only just skimmed through this. But I love Riocan. It will always be a core piece of my portfolio until I die, probably, because this is in my backyard, guys, and I really believe that the Canadian real estate market is poised to continue to expand rapidly, maybe not by price, but by population growth, considering the government's still expecting to immigrate about 1.8 million people by 2023. And then on top of that, we still have a shortage in housing supply. Now, again, there could be some issues along the lines, but considering they're going to be having, I think in Strata, they're going to be having Shopify as one of their major tenants. They have the occupancy ratings already built out. I just can't see how you're going to really lose any major money over the long term in this investment. But again, as it currently stands, I think the stock trades for a very fair value if you are willing to lock in a 4% yield here. I do believe the real value in this company was back in that $15 range, because I really like something like a Stag for growth, because I think they're doing a better job in the near term and the long run so far than Riocan has been. But again, I think this could change just because of these new properties coming online. So I'm looking forward to updating you guys farther on this company. Let me know what you think in that comment section below. But stay cool, stay awesome, and I look forward to catching you tomorrow.